Hi, welcome to module 3. So now we are going to learn principles of accounting. That means the some of the when we are studying accounts, we always learn about debit and credit. So we are curious to know what debit is and credit all these things is about. So over here we are going to give introduction onto the principles of accounting. That means what accounting is basically all about. So I'm going to give you an overview of this in this module over here. Okay, so now we are going to go through a slide here. Okay, what is profit and loss account? Profit and loss account is actually to count how much profit or loss. What is count your profit that your business make during a particular year. So this is the purpose of profit and loss account. Then what is balance sheet? Balance sheet is to list down what your business owe or what your company owes and what your company owns. That means to list down all your assets and your liabilities at a certain date. Okay. Then now we look at this separate legal entity. Okay, when you start a business or company, what you have in your mind is business, personal is personal. That means business money is business money, my own money is my own money. So keep it separate, don't mix. So this is the meaning, this is the simple meaning of separate legal entity. Then when we always heard about what is profit, what is debit, and what is credit. So now we think about the profit and loss account. In the profit and loss account, debit is bad because why I say debit is bad in the context of the profit and loss account, because debit will make the profit less and then credit will make the profit more. So that means if you debit an item in the profit and loss account, you are actually making the profit less, and if you credit an item in the profit and loss account, you are making the profit more. So that's why I said that debit is bad and credit is good in the profit and loss account. In the balance sheet, debit is good. In the balance sheet, if you debit an item in the balance sheet, debit is all the assets, and then you credit all the liabilities. So in the balance sheet, debit is actually what the company own. Okay, all the assets, all these are owned by the company. Credit is what the company owes. That means what the company owes to other people, including capital, is a credit. You know why capital is a credit? Because capital means the company owes the business owner money, or the business owes the business owner money. That's why capital is a credit in the balance sheet. Okay, so now we are going into the principle of account. So now these are the 6 chapters basically I will go through. Okay, then now go to chapter 1, which is page 2 of your notes. Okay, so here is the short form. DR stands for debit, then CR stands for credit. So now you imagine that you are opening a very small business. Okay, now you will have a bank account, your personal bank account you have. Normally we will have a personal bank account with POSB. In Singapore, normally we will have a personal bank account with POSB. So now you have set up this small company of yours. So you can also go to POSB or UOB or DBS or whatever bank there is, and then you can go to a bank and tell them that you want to open a company bank account. You want to open a bank account in the company name. So as you are the founder of this company, and there's no one else in this company, you are just a one-man show or one-woman show in this company. Actually, you will feel that the company is and you are basically the same thing, because when you open the company bank account, the bank will also give you the ATM card and give you the checkbook, and you use the ATM card actually practically like your own ATM card, because you can use the ATM card and then you can punch in the PIN number just like how you did for your own personal bank account. So it appears like when you start the company, and at this point of time, when you are a one-man show company, your company your company bank account and your personal bank accounts practically to you is quite the same, or I mean practically, not theoretically. Okay, so now we are going to look into this debit and credit. We are going to understand how debit and credit actually works to balance your profit and loss account and balance sheet. Okay, so now when you start a company, you put in $100 into your company bank account. So like just now, what we discussed, you have opened a company bank account. You have your personal bank account already, but now you have opened a company bank account. So you start this company. It is probably a very small company, probably a very low capital company. So you start this home-based low capital company. Okay, so not everyone is rich to start with a multi-million company. So but even if you are not rich, you can start a company and with just $100 for a home-based company. Okay, so you put in $100 of your own money into your company bank account. Okay, so that means you take from your personal bank account and then you put this $100 into your company bank account. So that means you are actually starting your company with a capital of $100. So you debit bank, then you credit capital. So this is how your balance sheet will looks like at the start. Okay, so you debit bank, that means the company bank will have $100, and over here we have shareholders funds and liabilities. So your share capital is $100. So on top here we put a double underline. Okay, so this is the total assets, and this part is the total shareholders funds and liabilities. Okay, this part and this part must balance. So that means you are putting $100 into this company, so that means your share capital is $100. Okay, so you have put a capital of $100 into your company. And where is the $100? The $100 is in the company bank account. Okay, so then if you have understood this, then now we go to number 2. Then you use $50 from your company bank account to buy a table and chair. A table and chair is the company's fixed asset. So even though you are doing a home-based business or a very simple business, you need at least a table and chair. Okay, probably a second-hand one, a very cheap one. Okay, so then that means you take out $50 from your company bank account to buy a table and chair. A table and chair is something that is a fixed asset because it is something that can use for long term. It can use for many years. Yeah, so it's your company's fixed assets. The table and chair will belong to the company. So that means now you take out $50 from the company bank account. So the bank just now was 100, so now you minus 50, so the bank will left $50. Okay, then you buy a table and chair. So the company now will have a table and chair. So under balance sheet here, assets, you have fixed assets, $50. Okay, the table and chair is your company's fixed asset. Your capital will remain the same. You know why? Because you have put in $100 of your own money as capital into this company. So the capital is still there. Okay, you have actually planted in $100 of capital into this company. This is a small size company. If it's 100,000 and this is 50,000 and this is 50,000, it's still the same. The principles is still the same. Okay, so now my question is, you have actually put in $100 of capital, of your own money as capital into your company. Then where is the money now? Where is the money now? $50 is in the company bank account, and $50 is in fixed asset. This is the company's fixed asset, not my personal fixed asset. So that means this $50 and this $50 belongs to the company. That means all these assets belongs to the company. The $50 in the company bank account belongs to the company, and the table and chair belongs to the company. So therefore the capital that I've planted into the company, $100, is shown in the fixed asset and in the company bank account. So this 100 and this $100 balances. So then now we look at number 3. Your company business is that of making dresses for sale. Now you need to buy cloth for making dresses. You use $30 from your company bank account to buy cloth. So over this part, just bear with me first, because actually I'm showing you how the debit and credit really works step by step. So don't think of a complicated stock valuation first. So now stock on the stock part, I will explain to you in one of the subsequent chapter. So now just follow with me on this debit and credit part first. Okay, so now again, your company business is that of making dresses for sale. Now you need to buy cloth for making dresses. You use $30 from your company bank account to buy cloth. So your company is that of making dresses for sale. You are probably like working from home, doing a very small scale business. So you take up $30 from your company bank account. So so now again, what is debit and what is credit? So now you see on top here, until this part, that means all this from the total assets above, all this is debit. Okay, you follow me? All this top part is debit. Assets, current assets. Okay, in other words, in short, total assets are debits. Okay. Then what are credits? Credits, shareholders' funds and liabilities are credit. Okay, so that means the below part is credit. So that means shareholders' funds and liability, this part is credit. Okay, you follow? Uh, okay, then in the profit and loss account, like what I explained earlier, in the profit and loss account, debit is bad because debit will make the profit less, and credit is good because credit will make your profit more. Okay, so now you take out $30 from your company bank account, so you credit bank. So you see, bank was originally a debit balance. So but now you make the bank balance less, so you credit bank. So that means you minus $30 from your company bank account, you take out $30. So that means the bank will left $20. Okay, remember just now the bank account was $50. So over here you take out $30 from the company bank account to buy cloth. So that means the bank balance will left $20. So now you credit bank. Okay, so because bank was originally a debit balance, you want to make your bank account less, so you credit bank. Okay, so then why did you take out that $30 for? Huh? Why you take out $30 from your company bank account? You take out $30 from a bank account because you want to buy cloth. So that means you have made purchases of goods for the company. So in the profit and loss account, debit is bad. So you debit purchases. Okay, so over here you debit purchases and then you credit bank. So now you will think, okay, you will think that means the company will have cloth, will have goods worth $30 in the company. So then how do I account for it? Okay, so then you will debit stock in the balance sheet, debit the stock in the balance sheet $30, because when you buy the cloth, there will be $30 worth of cloth in your company. So your company will have an assets of $30 worth $30 in the company. So you debit stock. BS stands for balance sheet, PL stands for profit and loss account. Okay, and then you credit the closing stock in the profit and loss account. Okay, so this shows how the debit and credit applies step by step to your balance sheet and profit and loss account. Then now you look at the profit and loss account over here. The sales is 0 because until now I have not made any sales. There was no opening stock because when my company first started, there was no opening stock. Okay, I made a purchase of goods of $30 for the company, but I haven't sell the goods yet. The stock is still there. The stock is still there. For example, if I close down this company now, I can take the goods, the $30 worth of cloth, and sell it away, and I get back my $30. So actually the cost of sales is 0. Okay, I buy $30 worth of cloth. The cloth is still there, so I have not incurred any cost yet. So the cost of goods sold is 0. Okay, some students ask me how come there are 2 columns here. um, just don't worry about 2 columns. If you want to put all in 1 column, it's okay. 2 column is because um, this one, okay, 0 plus 30 minus 0, this is 0. I can actually put the subtotal of 0 over here. So 2 column is just for better presentation. If you're so confused with 2 columns like this, then you can put everything in one column. So don't confuse yourself. This 2 column does not mean that this is debit, this is credit. No, don't think of that. It's just a better presentation. Okay, so if you want to put all in 1 column, you can. Okay, then now, so the $100 of my own money that from the day one that I planted in this company is still in the company. I have not taken out my $100. I have not taken out 1 cent of my $100 for my own use. Okay, all the $100 is still retained in the company. Then my question is, where is the $100 now? The $100, $20 is in the company bank account, $30 is in the company stock. The company has the stock of cloth of $30, and $50 is in the fixed asset. So the $100 capital that I planted into the company is fully accounted for over here. Okay, then now we go to number 4. Okay, number 4 says, then you use the cloth to make dresses for sale. A customer, Yvonne, liked the dresses and pay $500 to buy the dresses. The customer said, I pay you $200 now and the balance $300 I pay you next week. As you trust the customer, you agreed. So the customer owes you $300, which would only be paid next week. Your stock is left $10 because $20 worth of stock was used to make dresses to sell and sold to the customer. So this is very simple. So that means okay, you have $30 worth of cloth just now, so you use $20 worth of cloth. Okay, you use $20 worth of cloth and make it into a very nice evening gown or wedding gown and sell to this person called Yvonne, this customer called Yvonne, for $500. The customer says that can I pay you $200 now and the balance $300 I pay you next week. Okay, you agreed because this is business. If you don't agree, probably the customer won't buy, so you will lose out. So you agreed. Okay, so then that means your company made a sale of 500, so you credit sales. Okay, in the profit and loss account, credit is good. Sales is a good thing. You will make your profit more. You credit sales, then you debit bank. Okay, so then your bank will add 200. You debit bank, and you debit debtor 300. Okay, debtor are people who owes you money, people who owes the company money in this case. Okay, so you debit debtor because the person have not paid me yet. So that means the debtor is you can think of it as something like my bank also, but like my banker. Okay, that person is holding the 300 on my behalf, on my company's behalf. So when I need the money, I will actually maybe get this person to pay me quickly. Okay, get this. So that means I probably will take this 300 from this person, or in other words, if when this debtor pay me, this will become 0, and the bank will add 300. The bank will become 520 when this person pays up. Okay, so debtor is in the same category as bank and stock because it's the company assets. It's what the company own. Okay. Then this stock part. Okay, so you use $20 worth of cloth. So you credit stock. So the stock go up $20. And then you debit closing stock. Okay, so now you must think of this closing stock part. Okay, this is the profit and loss account. Okay, purchases is originally a debit balance. So here less. So closing stock was originally a credit balance. But now you want to make the closing stock less. So that's why you debit the closing stock because it was originally a credit balance. But you want to make this balance less. So that's why you debit closing stock. So you debit closing stock and then you credit stock. Then now look at your profit and loss account. Okay, when you originally purchased cloth $30. Then now the cloth is left $10. That is because you have used $20 worth of cloth. Okay, so that's why your cost of sales is 20. So this 20 I put here, and then I put here. This is just my way of presentation um, to make it nicer, make it more organized. Like what I said, if you want to put everything in one column, you can. So these two columns does not mean a lot. Okay, so this $20 I've transferred here $20. So the sales, I make the sale for 500. So okay, look what we have said just now. You use $20 worth of cloth, so this is my cost of sales, and sell it to your customer for 500. So that means I profit 480. So now you think of it again. When I started this company, I put in my own money $100. Then I profit 480. So that means my money in the company is 580. So this is shareholders fund. Okay, when I open this company, I'm the only one-man show. Okay, so I'm the only shareholder. So that means, in other words, this whole company actually just belongs to me as of now, because I am the only shareholder, only person running this company. It's just a one-man show, no other people involved in this company. So all this 580 is mine. I put in $100 of my own money into this company. The company profit 480. So total 580. All this money is mine. Then I ask myself, so 580, where is my money now? Okay, so where is my money now? Is fully accounted here. Bank, I have 220 in my company bank account. $300 I still have it with my debtor. When the person pay me, then this $300 will go into my bank account. Okay, then I have $10 worth of stock, worth of cloth. The stock is my cloth. And then I have $50 in fixed asset. So if I add up this 50, 10, 300, 220, the total will be 580. This is where all my 580 has gone to. So it's fully accounted for. So over here the total assets is 580. Here 530 means the total of the current assets plus fixed assets. So my total asset is 580. Okay, my shareholder fund and liabilities. There's no liabilities yet, but so my shareholders fund, my total shareholders fund is 580. So since I'm the only shareholder, so that means my funds is 580. And where is my funds applied to? Is applied to all these. Okay, then now we look at number 5. Now you only have $10 worth of stock. You need to purchase more stock. You purchase 150 worth of stock from your supplier, Karina. You told your supplier, I pay you $50 now, and the balance $100 I pay you next month. And your supplier agreed. So now what you have learned from this business is actually very profitable, because I use $20 worth of cloth. I'm not counting my own salary. I just don't want to count my own salary. Okay, I use $20 worth of cloth. I make it into a very nice dresses. I probably could have spent 1 week or 2 weeks making this dress, and I sell it to this customer for 500. So I know that in this sense it's very profitable. So now I want to buy more cloth. Buy more cloth. Okay, I purchased 150 worth of cloth, and then I tell my supplier, can I pay you $50 now, and the balance $100 I pay you next month? And the supplier agreed. Okay, so I debit purchases 150. Just now was 30, so plus now I purchase another 150. So the total purchases is 180. I credit bank because I pay the supplier $50 first, so I credit bank. $50 gone up from the bank, and I credit the creditor. So I owe the person $100 first, so I credit the creditor here $100. Okay, so then the stock come in 150. I debit stock because when I buy the goods, I will have the stock of 150. So I debit stock, so the stock at 150, and I credit closing stock. So the closing stock increased by 150, so credit closing stock. Okay, so now similarly this is the profit and loss account. Okay, I buy 150 worth of cloth, so the cloth 150, and the closing stock also add 150, so closing stock is 160. So my cost of sale is still the same like just now. Here add 150, here add 150. Cost of sale is still the same like just now, because I just buy, I haven't used. So the closing stock is still there. The gross profit is still the same. Okay, So my shareholders fund is 580 plus I owe the person 100. So creditor, that means I owe the person. Okay, so if I owe the person, that means directly or indirectly, so in this case it's indirectly. Indirectly, I have somewhat borrowed this 100 from him. Yeah, it's actually somewhat borrowed because the person supply me the cloth, but I have not paid him. So I owe the person. It's indirectly like the person is financing my goods first. Okay, financing my goods first. Of course I will have to pay him later, but as of now, it's still, this $100 is still owing to the company. So let me give you an example. For example, I buy the cloth 150, and then what if this supplier tell me, okay, you cannot buy on credit. That means you buy the cloth now, you have to pay in full, no choice. So if the company is short of money, I can like um, borrow a money on behalf of the company from someone, from a friend or somebody. Okay, so that friend actually lend $100 to the company, and the company use this $100 to pay the supplier. So over here in the balance sheet is still creditor, because that friend whom we owe to is still a creditor. So that means it's still a creditor. So here is the case is, we have really, the friend has actually really lent this $100 to the company. So that friend has actually financed the company with $100. Okay, so $100 was put in by my friend. Okay, was actually borrowed from my friend to this company. So that means the total financing given to this company is 680. Okay. Okay, so the stock will add 150 over here. Okay, so uh in the second example just now, the supplier has been paid in full. uh okay, so 680 financing has come into the company. So where is that 680 now? Okay, 680, as you see over here, is fully accounted for in these assets. So this is how the debit and credit works. Then now number 6, you ask your friend and to work in your company part-time for $50 a month. This may not be realistic in Singapore, but we are just doing this as an example. Okay, so she will start work on 16 October 2013, and her first salary will be due on 31st October 2013. Her first salary will be paid prorated based on $50 a month. After some detailed discussion, your debtor Yvonne say, I will pay you another $100 now, and the balance $200 I will pay you in 2 months' time. You also make arrangement with your creditor Karina to pay your $50 now and the balance $50 in 2 months' time. At the end of the month, your company water and electricity bill is $20, and you paid the bill, assuming that your company was opened or incorporated on 1 October 2013. Your company name is Beautiful Dresses Private Limited. Prepare the profit and loss account and balance sheet for your company for 1 October 2013 to 31st October 2013. Show all journal entries. So now your company is having expenses. So you have salary expenses. The person work for you half a month. Okay, based on the rate of $50 a month. So that you have paid your staff $25, your part-time staff, and you have paid $20 of water and electricity expenses. So in the profit and loss account, expenses is bad. So debit expenses, debit salary expenses, water and electricity expenses, and then you credit the bank. So now look at this. So over here, expenses, salary 25, water and electricity 20. Then you credit the bank. The money go up from the bank, minus from the bank, $45. Okay, so this is profit and loss account and balance sheet. Okay, let's go through the debit and credit first. Okay, then your debtor says, I pay you $100. I pay you another $100. The balance I will pay you in 2 months' time. So that means $100 comes into the bank account. So debit bank and credit debtor. Okay, so the bank will add 100 and the debtor will minus 100. Then you also told your supplier, I pay you another $50 now, the balance $50 I will pay you later. Okay, so you credit the bank 50 because the money go out from the bank, and you debit the creditor because your creditor will become less. You owe the person less. Okay, so you minus from the bank 50, you credit the bank, and you debit the creditor. Okay, so then now look at this profit and loss account and balance sheet. Um, okay, so now you have sales minus cost of sales 20, then you get gross profit 20. Okay, in this case, our business is that of making dresses for sale. Gross profit is something like your trading profit, something like your main profit of the company. The main cost of your company is basically the cloth. Then the main income from the company is the sale of the dress. Okay, so then from this you derive the gross profit 480, then less expenses. These expenses is something like other expenses of the company, like overheads of the company. Okay, these are expenses that are not directly relating to the trading of the main trading business of your company. Okay, so your expenses will be the salary and the water and electricity. So here 45. So 480 is your gross profit minus your expenses 45. You get your net profit. So the net profit will add to my shareholders funds. That means this 435 is actually my money. So this is the total shareholder fund. Add your liability is 585. And this 585 is fully accounted for in your assets over here. Then now, from chapter 1, what have we realized? What have we learned? Okay, so do you realize that from chapter 1, credit is actually the source of financing? So source of financing, that means where the money come from. And then debit is actually the application of funds. That means where have the money gone through? So it's gone to. So for example, I put in $100 into my company. Where is the money now? So the source of financing is capital. So credit capital. The money, the capital come from me, come from the business owner, come from the shareholder. Okay. Debit is the application of funds. That means where is the money now? Where have the money gone to? So I put in $100 into the bank account, into the company. So where is the money now? The money is in the company bank account. Okay. So debit, bank, credit, capital. Then example number 2. Okay, the company made a sale of dress of 500. Where has the money gone to? Okay, so where is the source of financing? The source of financing is the sales. Okay, the company made $500 from sales, so credit sales. Then debit is the application of funds. So where is the money now? The money $200 has been gone into the company bank account, and $300 is still with the debtor. The debtor still owes $300. So this is where the money is. Where this is the application of funds. This is where the money is. This is the source of financing. The source of financing is the sale. Then example number 3. How come $1,000 is gone from the bank account? So you credit bank 1,000. So where have the money gone to? Okay, debit is the answer. Okay, the company has used $800 to buy fixed assets for the company, so debit fixed assets. Okay, the computer is the fixed assets. Okay, debit fixed asset. And $200 was used to pay telephone bills, pay the company's telephone bill. Okay, so debit telephone expenses. So this is where the funds has been applied. Okay. Then now we go to chapter 3, accrued and prepaid. Okay, what is accrued? Accrued means not yet paid. Okay, accrued means not yet paid. It can mean that other people not yet pay me, or I haven't paid other people. So look at this example. Your business telephone bill for October 2013 has not come yet. You estimate it should be $30. Okay, so that means for October 2013, you have incurred the telephone expenses, you have used the telephone, but the bill has not come yet, so you have not paid. Okay, this is accrued expenses. That means it has been expensed but not yet paid. So you debit telephone expenses $30. That is because you should still treat it as an expenses even though you have not paid the bill yet. Okay, and the $30 is actually owing to the telephone company. So credit accrued telephone expenses, and then put this under current liabilities. So that means this accrued telephone expenses is in the same nature like a creditor. Okay, this term is not fixed. It's not fixed, that means that you can actually put another word or another phrase to replace this. Some people can put this as telephone expenses outstanding, is correct, or you can put it as telephone expenses unpaid, is correct. But over here I would like to put it as accrued telephone expenses, is also correct, because it actually describes this liability. Okay, so some people can put it telephone expenses payable, is also correct, because it is correctly described what this liability is about. So that means, in other words, you must think, yeah, correct, I owe the telephone company. So let's look at the balance sheet. Okay, in the balance sheet, the telephone expenses here are debit telephone expenses, right? So it's treated as an expense in the profit and loss account, and it is treated as a liability in the balance sheet. So accrued telephone expenses. So I put it in the same category, in the same subheading as creditor. That is because the telephone company is actually my creditor, correct? So I put it in the same category as creditor. Then here, prepaid. Prepaid means pay beforehand. Okay. So that means pay before it's due. Remember, okay, when the money go into your bank account, you debit bank. When the money go out of the bank account, you credit bank. Okay, now, for example, you paid Cindy's November salary of $50 on 29 October 2013. Sometimes your staff will ask you for advance salary. So, and you may agree. Sometimes you agree. Okay, so on 29 October, you paid your staff November salary in advance. Okay, this is supposed to be 2013. So this is a prepaid salary expenses. That means the expense is paid before it is due. So okay, first of all, you credit bank because the money $50 go out from the bank, and you debit prepaid salary and put under current assets. This one means that this staff Cindy is something like my debtor, because now you think of it, she owes the company $50. Okay, at 31st October 2013, she will owe the company that $50, because if for example end of October she resigns, okay, she has to pay back the advance salary to the company. So that means indirectly or directly, she actually owes the company $50. Okay, at the end of October she actually is owing. So this prepaid salary we put in the same category as debtor. So over here under current asset we put prepaid salary. We can also put it as advance salary, or you can say salary paid in advance. So that means this term is not fixed. You can actually replace it with another term of a same meaning, of a similar of a same meaning. Okay, for example, you can say advance salary. Okay, so here $50, and the 50, and so that means you have debit prepaid salary and you credit bank, because the money $50 go out from the bank, and the $50 is a prepaid salary, and is classified under current asset because it's in the same nature like debtor. So the staff owes the company money, so it's put under current assets. Okay, so this is how the debit and credit works. So remember, over here now the total assets is still same as the total shareholder funds and liabilities. So if that means, in other words, if your debit and credit is correctly applied, your balance sheet will always balance. So now chapter 4. Okay, so now you realize that it is important to prepare final accounts, trading account and balance sheet of your company, so as to give a clear picture of the financial status of the company. Okay, so now in the earlier module 2, you realize that you need to do the financial statements of the company. So when you do the financial statements of the company, it's very important to do the final accounts, the trading profit and loss account and balance sheet. So that means when you are doing a small business, just like what we explained just now, the business is so small, the company only sell a dress during the year, for example, and there's so few transactions. Okay, the company only made two small purchases during the year. And you must think of what is the objective of 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 the accounting. The objective of the accounting for like what we explained in earlier modules, as you are a private exam company, at the end of the year you will need to produce the financial statements, your financial statements for the company. And the financial statements is needed for submit for for the purpose of income tax. So that means practically actually um, what do we need? Okay, so that means you may have read some very thick accounting books, and you said, oh, accounting is so difficult, I rather give up. How am I going to manage so many things in my company, and my company isn't making much money, it's just such a small company. How am I how is the company going to pay an accountant such huge amount of money to do all these complicated accounts? And anyway, the company accounts is not complicated because the company operation is so small for this year. So that means you can actually so-called disregard all the typical accounting procedure, but focus on what the company practically need. Okay, what the company practically need. Okay, when you are doing business, you practically need to keep all your proof of transaction, just in case, like when people sue the company, or when the customer don't pay up, you want to sue the customer, or even don't come to this, when your customer don't pay up, you want to like talk to them nicely and then show them the proof that they have actually purchased the goods. um, then actually you need to keep your source document properly. Source document, as when we discussed in module 5 on tax matter, the income tax department actually uh, wants you to actually keep the source document. Okay, keep the source document in the company. Anyway, for practical purpose, you need to keep the source document, because these are the proof of transactions with external party. Okay, proof of transaction with external party, which in case any dispute, the source document is very important. It is very important to resolve dispute. So example of source document are all over here: official receipts, invoices, check counter, foil payment vouchers. So tenancy agreements, all these are documents that you transact business with external party. These are proof of transaction. So keep all these proof of transaction. Okay, so in module 2 we have discussed some simple way of keeping accounts. Okay, that is one example. Okay, so that means if your business is small, you can actually disregard all the typical accounting procedures that you may have learned before in some textbooks, or some of the things. So as long as from the source document you can actually prepare your final accounts, your profit and loss account and balance sheet. And also, in order to do your financial statement, you have to prepare your cash flow, which we have learned in module 2. Okay, as long as you can serve this purpose, that means keeping all the source document as proof of transaction for your business, and you prepare the final accounts, and you are able to prepare your final accounts from the source document. That means the figures in the source in the final accounts can easily um, tally with the source document. Then it's okay. That means from the final accounts, you can actually find the source document that relates to that transaction quite easily. Then it's okay. Then it serves your purpose. It serves your purpose already. But as a brief overview, we will look over here that generally the business need a source document, a book of prime entry, a ledger, trial balance, and final accounts. But if you can cut short the procedure, you just keep the source document, and at the end of the year you are able to produce the final accounts. And the final accounts figure can be easily be identified, can be easily linked, can be easily linked to the source document, can be easily be identified to the source document. Then it's okay. Because if you look at this case, look at my accounts this case, my sales is 500, so that means I only have one sales invoice, because it's only for one customer, so it can be easily to identify to the source document, so it's okay. Purchases 180, I only made 2 purchases, one is 30, one is 150. So if this can be easily be identified to the purchases invoice, then it's okay. I keep the source document, and then this bank also, it can be easily identified to my check counterfoil. So you will have a checkbook, then every time you issue a check, you will write in a check counterfoil. So if the bank movement can be easily be identified to the check counterfoil, then it's okay. That means I have all my proof of transaction can be easily identified to the source document. Then it serves the purpose. Okay, so that means whatever principal accounting that you studied, you must think of it from practical point of view. Then it will only make sense. Okay, so over here, as I've said, I will go through just the brief part. We have not designed an advanced level of principal accounting where we will go through more complicated things. But for now, we are just going through the brief part of it. So this is it. Okay, so now we are going through stock. Okay, so when we learn about stock valuation, we actually, in the more advanced level, we will learn about periodic stock. No, I'm sorry, perpetual stock. That is more advanced level. So over here, we are not studying anything about perpetual stock system. We are only concentrating on periodic stock, which is periodic stock is more applicable for smaller businesses, whereas perpetual stock system is more applicable for bigger businesses, more complicated and bigger businesses. Okay, so now we are only concentrating on periodic stock, which is more popular with smaller businesses. Okay, so just now from inside chapter 1, now roughly look at your chapter 1. Okay, you see, every time you debit stock, the correspondent entry must always be the closing stock. So that means, in other words, this closing stock and this current asset stock is always the same. So, and when you do your double entry, this thing is always in a pair. This stock is always in a pair. Okay, so if you debit closing stock, then you credit this stock. Okay, so it's always in a pair. So that means in the periodic stock system, that means in the normal small businesses, actually you can do one thing. For practical reasons, you can save your time to do any journal for stock, any debit and credit for stock. Okay, you can disregard stock until end of the year. Until end of the year, when you need to do your financial statement, when you need to do your accounts. So but for practical reasons, you can keep a stock movement record. For example, like this. So that means you can list down all your stock item, your quantity at the beginning of the year, at the beginning of the period or beginning of the year. So whenever the stock come in, you put in this column. Whenever the stock go out, you put in this column. Then you always update it. You always update these things. You can do it in Excel spreadsheet, or you can write in an exercise book. That means, in other words, you are monitoring the quantity of stock, manually. This is practically useful for small businesses, is because then when you see that the stock is running low, then you start to order from the supplier. So then you can monitor this way. Okay, so but this is just for practical reason. Some companies, even they disregard the stock, don't care about stock until end of the year. Okay, yeah, which is okay for accounting purposes. Okay, So at the end of the year, you may like to close down your shop for one day for the purpose of counting the stock, okay, for the purpose of stock count. So during the stock count, you will go and list down all the stock that is in your store, then put down all the quantity, then find out the cost of the stock, and see if and make sure that and see if any of the stock are selling below cost. Okay, for example, Cadbury chocolate, it is expiring soon. So even though the cost is $5, but now the selling price is $2. So that means the value of this Cadbury chocolate, I would take the the current selling price, the current worth of this Cadbury chocolate, even though the cost was higher, but now it's worth only $2 because it's expiring soon. So the value of Cadbury chocolate is $20. But others, I just take the cost times the quantity. Okay, the selling price is higher, that's normal, it's okay. So I take the cost of the stock. But if there's some exceptional case where the thing is spoiled, partially damaged, or expiring soon, then you take the current value, the current sellable price, the current sellable price of those that have damaged or expiring soon. Then you get the total value of all your stocks. Then at the year end, once you get the total value of the stock at the year end, you just put that stock figure in your balance sheet and the same figure in your profit and loss account, in the closing stock in the profit and loss account, and you can do the accounts as it is. Okay, because at the end of the year, you only need the year-end stock figure to put in your balance sheet and your profit and loss account for the purpose of doing the final account. So this method, you can use this method. That means throughout the year you can disregard stock until end of the year. Then you get the value. Then you calculate the value of the stock at the year end when you want to do the final account. Okay, so this is a way of accounting for stock under the periodic stock system. Okay, a simple way of accounting for stock. Then now we think of what is depreciation. Okay, depreciation is in simple term is how much the fixed asset has lost value during the year. So it's treated as an expense in the profit and loss account. This one we have also gone through in module 2. So now we are actually are going through the more basic of depreciation. So that means, for example, you buy a car for 50,000, it can last you for 4 years. At the end of 4 years, your car can be sold for 10,000. How much is the depreciation for your car? So that means how much your car lose value every year. Okay, so 50,000 minus 10,000, because at the end of 4 years your car can be sold for 10,000. Okay, so divide by 4. So that means every year your car will lose value 10,000. So that means the depreciation for your car is 10,000 a year. So what is the net book value at the end of year 1 and year 2? Net book value, that means what is the estimated value of your car at the end of year 1 and the estimated value of your car at the end of year 2. Accumulated depreciation, that means at the end of, for example, at the end of year 1, how much your car have lost value already. So in year 1, at the end of year 1, the cost is 50,000 minus 10,000 is the accumulated depreciation. That means how much the car have lost value already. So the net book value is 40,000. That means at the end of year 1, my car is estimated to worth 40,000. Then at the end of year 2, my car is estimated to worth 30,000, because at the end of year 2 the car has lost value 20,000 already. The cost is the same. Yeah, the cost of the car was actually still 50,000. This part, financial statement illustration, I have actually gone through in module 2. That's why I said that in order to get a full picture, we should I mean, not to say a full picture, a more complete picture. We should go through all the modules, so that we also have a better picture of what it is happening. So this this financial statements thing actually we have gone through in module 2 already, so I won't be repeating over here. So okay, so for now, if you have any question, you can put it on the comments, put it on the comment on the web page, and I will try to answer it as best as I can. Okay, hope to see you again in other modules. Okay, thanks for watching.